Hello and welcome to this week's strategy video with me, David Jones, and Trading 212. Now, last time around, I said we were going to start off talking about price action, and we do this over a couple of videos. And last time we were talking about looking at how the market reacts when it gets near to previous highs or previous lows, and how it can give us low risk, potential high reward trades. I also said that doesn't work all the time. You know, sometimes when the market gets near these big levels, it looks like it's going to turn again, but sometimes we get breakouts. For example, in the last week, we've seen a breakout for the Australian dollar against the US dollar, moving out to a two-year high. So this week, we're going to focus on how we might want to trade a false breakout, because just because a market gets to a level, it's not broken for a while and pushes through, it doesn't necessarily mean that that's it, the market's going to carry on higher. I'm sure plenty of us, if we've ever tried trading breakouts in the past, know that there are plenty of false breakouts there where the market pushes through either up or down, looks like it's starting a new trend, and then promptly reverses and goes the other way. But this isn't necessarily a bad thing. You know, this can still provide opportunities to trade the market, to again give us this low risk but high reward entry point into a trade. So as usual, first of all, before we look at any real examples, let me just scribble down and show you what I'm talking about when it comes to false breakouts and why using price action, they can still give us trading opportunities. Let's just remind ourselves from last time around what we were looking at when it came to price action trading. We were looking at a simple setup where the market finds strength like this ahead of a previous low, and we were looking to buy in if that happened. And that's fine, of course, when it works, but as ever with all these things, nothing works all the time. Now, we have a situation where a market may do that and break through the previous support. We've covered this sort of thing in the past when we're talking about trading breakouts, and in an ideal world, we want to be a seller here, and the expectation is for the market to maybe sell off like this. But again, that doesn't happen all the time. So let's just take a couple of steps back here. So we're in the situation where the market has broken below the low. This has changed, I think, plenty of people's perception of where there is value in the market. We may well have seen buying coming in around about the 100 level before. That hasn't happened this time round. But if a market breaks a big level and we don't get the suspected follow through, there could be an opportunity. So the market does break below this previous low, but we don't see the market sell off. It pushes a little bit lower, but then starts to stabilize. Once again, we could have an opportunity here based on what the price action is doing. If it does turn out to be a false break, then what we're looking at for the market to have pushed lower, but then really have to gone nowhere. So here we've got another low risk potential high reward opportunity. If we're buying in here, let's say at 90, and the low that we've seen is 85. If we've seen the market stabilize like this, setting up potentially a double bottom, we've got an opportunity to be a buyer with a relatively tight stop. If it does end up being a false break, it's completely reasonable for the market to push back in to the range it was in before at the very least. So it can give us a low risk and again potential high reward setup. So here's the flip side. In a market that's been hitting a level it can't get through, so the expectation is for the market to fall away again from this level. But if we get the false break, it might look something like that. And again, the trade here is to be a seller, to short sell here with a stop loss above that most recent high. If it is going to be a false break, it's pushed out, and the expectation would be for the market to, at the very least, pull back into the most recent range. So even if you see big levels break on charts, it's still worth keeping an eye on them to see if you get the follow through after the break. And if not, just keep an eye on what that price action is doing. If we get a lower initial high after that first breakout high and the market starts to pull back, it can be an opportunity to sell with a relatively tight stop and looking for the market to pull back into the previous range. Okay, so that's some of the theory about how to trade a false breakout. We wait for the breakout to slow and then we see if the market turns around. And it's always easy to explain these things in theory. So what I'm going to do, as usual, is look at some real examples. And this week, we've got 3 real examples. Now, these things are not uncommon, these sort of patterns. So let's start off, first of all, with a short-term example. Here's a great example in gold from the 19th and the 20th of July. So what we're looking at here, this is a 10-minute candlestick. So 19th of July, early hours in the morning, the price of gold is drifting off. And you can see here, it sets a low between 10 to 9 and 9 o'clock in the morning. Trades as low as about 12.35. The market bounces back during the course of the morning and the early afternoon, up as high as nearly the 12.44 mark. So we saw a good move off that level. So it's clearly left a very big level that plenty of traders will be watching. Now let's jump here to the end of the chart. Let's see what's happening here. So this is the 20th of July. Again, it's sort of in the morning, so from between 9 and 11, 12 o'clock in the morning. The price is selling off. It looks like it's going to hold over these old lows, bounces back, but then starts to trade lower. And as the morning goes on, it breaks below that previous day's low. So again, this is a suggestion, this breakout, that maybe the price is going to start trading low. We've broken a big short-term level, the lows from yesterday. But let's see what happens next. Remember, these are 10-minute candles. So this, if we're looking at trading false breakouts, it's a move like this that makes us study the market a bit closer and think, right, okay, is the market going to follow through? So let's see what happens. So you can see over the next 2 10-minute candles, so over the next 20 minutes, the market does bounce back up. So we've got what does look like a false breakout. So the market's sold off below that low, but we haven't seen the follow through. Really quickly, the market's reversed. So we may want to be a buyer back here around about 12.37.5 with a stop loss just beyond that previous low. Because if this is going to be a false breakout, by definition, if the market sells off, it shouldn't take out that first low. So we might have a stop the other side of 12.35 and we're a buyer at 12.37.5. Let's just fast forward in time and see what happened next. So this would have been on the 20th of July, around about 1 o'clock, where we would have got in with our stop the other side of that low. The market goes a little bit sideways, then starts to rally, and then really rockets ahead. So you can see just how these false breakouts, if the market does end up recovering, can set up low risk and potential high reward opportunities. So there's our short-term example. Let's have a look at another one. We'll step the time frame up a little bit, different market, slightly longer term time frame, and let's see how this price action trading on false breakouts might have worked. Right, what we're looking at here is dollar yen from the 18th through to the 20th of July. And each of these candlesticks represents an hour's worth of trading. And you can see a high has been left on the chart from a couple of days ago. If we assume we're here on the 20th of July, 8 o'clock in the morning, back on the 18th of July at 9 in the morning, the market had traded as high as 112.37 and then sold off over the next day and a half, slipping back towards 111.50. So we'd seen something like an 80-point drop off that level. The market starts to recover and we're getting back near to the old high. Now the assumption is the market's going to run out of steam up here, so some people may well be selling short. Let's take it forward an hour at a time. So the market's nudging that level. So we've got the first sign of a breakout. So some people might think, well, if we see the market follow through here, we're going to see a much stronger recovery in dollar yen. Let's see what happens in the next hour. The market pushes a little bit higher again, so we are pressing that level. And for some people, again, this will be a breakout. But if we're looking for a false breakout, what we're looking for, we've had 2 hours now where the market's pushed through that level without making any real progress. Is the market going to run out of steam? So in the next hour, the candlestick does this. So an aggressive trade here based on the price action. Yes, that level has been broken, but it's only been broken by about 4 or 5 ticks. We're assuming this is just a false little breakout, and based on what the price action's doing, the market has reversed, we could look to sell short. So if we're selling here around about 112.29, our stop loss would go somewhere the other side of here, maybe 112.50. And we're assuming it's a false breakout and the market is going to pull back into the range. Let's walk it through hour by hour. Once again, the market starts to sell off. We have an hour where it goes sideways, but then the market does push much, much lower. So there's an example there when it's pushing near a resistance level, an opportunity to sell short if a level gets probed, but there's no real follow through. Let's look at our final example now, just to show that this does work across all time frames and all sorts of different markets, because it's just the price action that we're looking at. So let's look at a longer term time frame again and another different market. So what I've chosen is the share price of Apple. I thought it's one that we all know, and we're looking at a daily chart here. I've had to go quite back in time. So this is the period September 2015 through to April 2016. So what we're interested in are the lows, first of all, down here. So we've seen that the Apple share price fell from about $122 down as low as the 94 level, bounced back up to 112, and it's currently, when we're looking at this chart, trading around 106. So let's just pick up on those lows from down here. So clearly that was pretty good support. We'll right click, we'll change the color to make it all a bit clearer. And now we're going to jump forward in the future. So we've jumped forward here. We're now looking at the end of April, beginning of May. You can see the price has actually gapped down. Maybe there was an earnings that came out. The market was a bit disappointed. The share price gapped. But it looks like so far it's holding. It's holding around this 92.5 level. Now some people may be thinking, well, I'm going to buy here. I'm going to buy and put my stop loss below 92.5. Perfectly sensible strategy. But when we're talking about it from a price action, trading a failed breakout, let's take a couple more steps forward in time to see what happens with the share price. So we've jumped forward to the third week in May. Now, if some have been buying here with a relatively tight stop, maybe not even that tight, if they're buying at 93 with a stop at 90, they'd have been taken out with this sell-off. So we've had one day where Apple has moved quite sharply lower below that level. So it could well be the start of a breakout, but of course it could also be a false breakout. This is where we've got to watch the price action to see what happens next. So over the next couple of days, following that breakout, we haven't seen a follow through lower on the price. So we've seen the price actually regain this old support, and it's currently trading around about $94 a share. So if we're trading off the price action, assuming this is a false break, an aggressive strategy here is to be a buyer wherever it's trading, around about 94, with a stop loss under that low, under that false breakout so far point. So that would be, the low was 89.42, so maybe a stop loss at $89. So we're a buyer at 94 with a stop loss at 89. Let's see what happens next. So the price has moved higher. We've traded back up to 100, briefly above $100 a share. So at the moment, this is looking like a false breakout. Now for some people, that sort of move would be enough. Other people may be looking for a bigger move. Let's have one last look at the Apple share price to see what happened over the next few weeks. So here we go. We've jumped forward quite a bit here. The breakout started in May. The market did push higher to 100. It did come back down and test it before pushing much higher and back beyond those previous April highs. So there's an example. It's clearly quite a great example because the market has moved so much higher, but just an example of how watching the price action, seeing it break below for one day, but then stabilize, can still give us a low risk but high reward opportunity, even on the higher time frames like this when we're looking at daily charts. So there we go. There are three examples showing where using the setup of a false breakout, then watching the price action can give us an excellent trading opportunity. As usual, I have to stress, this doesn't work all the time. You know, we do get breakouts where the market never looks back and then carries on in the direction of the breakout. This is why it's really important, more important than ever, to be disciplined with your stop loss. If you're buying, for example, a break of support, assuming the market's going to recover and it's a false breakout, you do not want to be in a trend that suddenly falls away. So having that discipline with stop losses, cutting your losses tight, so cutting your losses quickly, but giving it an opportunity to develop into a profitable trade if it does go the right way, is really important. That's it for this week. We'll wrap up this session on trading strategy using price action. As usual, if you're not subscribed, if you click the button there, you'll get notified whenever we upload a new video. If you like the video, click the thumbs up at the bottom. And if you'd like us to cover anything in the future, or you've got any questions about what we've talked about today, we do read all the comments So just leave us a message in those comments below. But for this week, from me, David Jones and Trading 212, we'll wrap things up there, and I hope you have a good trading week.